Good afternoon, everybody, and welcome back to the weekly market analysis after a week off last week. This is the analysis for the week ending November 17th, 2023. We are halfway through November. We had OPEX today, a lot of things going on. Before we jump into it, don't forget to hit the like button and subscribe to the channel. You can also find me on Twitter at Mr. J. Thomason or subscribe to my weekly newsletter at befinanciallyfree.substack.com. That comes out every Sunday morning for your reading pleasure. As we jump back into the markets today, I think what I'm thinking about right now and today and the last few weeks is the importance of process. And as you know, a few weeks ago, let's see, so the last time we had a video was on Friday the 3rd, after we had just had a really huge bounce across equity markets, a huge decline in decline in bond yields, increase in bond prices, dollar down, continued moves to the upside in gold, crude oil coming down, and so on. And one of the things that I want to emphasize, like I was saying just a moment ago, is the importance of process. And as I continue to reflect, and I'm just candidly here as I reflect on the last couple of weeks in the markets, one of the mistakes that you can make as an investor, as a trader, is deviating from your process. And definitely a lot of times, especially when the crowd is loud, or when there are individuals, high net worth individuals, investors, macro people who are pretty good, usually people who are reputable. Sometimes when you allow those things to sway you, when you allow other people's opinions to sway you away from your process, that's where the mistakes get made, and that's where you either miss opportunities or you lose money. And those are obviously things I've been reflecting on the last few weeks, as more and more. I mean, hindsight is 20/20, but more and more the bounce at the end of October was something that investors should have been involved in, and we even covered a few of those items in this channel back on Friday the 27th. In my newsletter over the last few weeks, we've talked about the uncertainty in markets, and definitely this is something where, just think about what could have been made on the rise the last few weeks if a person had just stuck to their process. And definitely that's something that I'm still working on and still growing in. Obviously, there's always going to be room to grow, always going to need to tweak things, always going to need to improve the system. But that's the important thing that I'm thinking about today. And so obviously it's not sexy having a process, because you're not, when you have a process, you're not one to create hype. You're also not one to be a doomsdayer. You're just process oriented. You look at the same things. You refresh your models, and so on and so on. It's just relentless practice, relentless fine tuning, relentless back testing, and so on. And a lot of people don't have time for that, and I think that that's why a lot of people end up losing money in the markets over the long run. And that's definitely something to keep in mind. I'm going on some tangents here, but there's definitely a reality out there that if you have a narrative that you want to support, there's a chart for it, or you can make the chart say whatever you want. So, for example, who could have foretold this astronomical rise the last couple of weeks? Well, some of my processes would have suggested that, not that it was going to go this far, but that this would have been a spot to exit your short or cover your shorts and to potentially get long. But if I wanted to make a chart that said this was the most bearish thing ever, I could have. If I wanted to say, oh, this is the spot where you should buy the dip, I could, in hindsight, you could find a chart that would tell you that it was obvious. But you can play that game all day long. But the point is that what you should be doing is looking at the same charts, the same data, with a fresh eye, consistently over and over again, and let the data tell you what's happening rather than you having a narrative or subscribing to a narrative and then looking for the charts that support your narrative. So with that, looking at the markets here, my process tells me that the equities are more likely to go to the upside than to the downside. You've got a lot of people that are eager to short the market here because the argument that they're giving is it's been too far too fast. I mean, if you go from the close of trading October 27th, S&P is up over 9% in just a matter of a few weeks. And I think that's 3 weeks of time that has gone by that we've gotten that rise. And a lot of people who try to fade price have just been getting rocked the last couple of weeks. And my process says that, or among my processes, suggests that the probability of upside over the short to medium term is actually much higher than the probability of downside. So let's go into the process here. So if we just start with the indicators that I use on the charts, one of those is the tide indicator, as you see, the colored line and then the faded gray line. And we got a bullish tide cross confirmed this week. And after having confirmed the bearish tide cross last week. And so, while typically the signal, it's not on the signal itself that you take the long entry, typically my process is once the cross happens, you wait for the tide for price to come back to the tide line. And then depending on where it settles, that's where you take the trade. And so for my process, for example, my rule is that once the tide line, if the tide line gets pierced, then you take the trade to whichever direction the tide is. So in this case, it would have been bearish tide, and then you set the stop loss above the last swing high, which would have been here. And so that's a situation where it's a high probability setup, but high probability doesn't mean guarantee. And so obviously I ended up getting stopped out through my system on that action. And then the bullish tide now suggests that, price at some point will come back towards the tide line. And when it does, the statistical probability is that the price will continue back to the upside. And I know a lot of people are looking to go bearish here, but the system says that the price is more likely to move to the upside. More on the process. We have VIX back in bearish tide. This just crossed at the end of last week. And so on that, or actually going into this at the end of last week and into this week. So obviously bearish tide. We've been in bearish tide in VIX since late November of last year, and obviously the markets have gone up over time since then. And so that's a signal telling you that the probabilities are for more upside. More on the system. A couple of different things that have taken place. We got a bullish tide cross on the high beta to low beta ratio, as well as a tide cross, or not a tide cross, as well as maintaining the bullish tide on the breadth indicators that I have. And we've gotten back into bullish tide on VVIX to VIX ratio. These are all market risk, systematic market risk crosses that I keep track of. Those all suggest risk on is higher probability. The stocks above their 50-day moving average have moved well off of those October lows around the 10 level. And we are on the positive side of the 50 line, which again is suggestive of continued movement to the upside in equities at least. And then the bigger one from a medium-term perspective is the stocks above their 200-day moving average, which has moved and closed over the 50 line for the first time since September. And so that's a sign that upside is to come. If you go back across the time series, then when you get those big moves to the upside, they tend to come when the stock's above their 200-day moving average is above that 50 line. Again, that's systematic in nature, and so that's a big deal to also take account of as well. Further, some more things that we could look at. Let me go to my Bulls Bears AAII data. Let's look at the time series. So on the time series, what you'll notice is on the right side, if you see where my mouse crosshairs are, we had this really significant dip in the Bull Bear spread at the beginning of November. The sentiment was extremely bearish at that point. Obviously, that's where we got the bounce. That was another piece of data that would have helped you at the end of October and into early November. And now we are more skewed bullish than bearish, but we're not at extremes yet where there are typically reversals. And so that's another part of the systematic process that helps us to see that upside is probably more likely to come. If we look at flows data, the most recent flows data suggests that, I think something's wrong with my chart here. Sorry about that. Most recent flows data suggests that investors have been selling equities, which means that a lot of that, it kind of reflects that bearish sentiment that had been happening. And so obviously if asset prices are going to go up, it's going to create a self-fulfilling mechanism of chasing. And so that's obviously going to be a big deal as well. So those are just a couple of examples of elements of a systematic process that suggest, on balance, that markets, risk assets, equities particularly, are going to be heading to the upside over the next few days. In the medium term, there's some caution, let's say short, medium term. One of the things is like the RSIs on equity indices, S&P, NASDAQ, and Dow are pretty high, close to the overbought 70 range, kind of that overbought range. I will say this, that typically, as far as equities are concerned, when you hit that 70 range, it's not quite as reliable a signal for selling as it is when it's an oversold at 30 reading. You need to really get the RSI to like 75 in equities in order to get some kind of substantial reversal that takes place. Or obviously you get some RSI divergence, but typically, I'm just saying on these moves, on these strong moves to the upside, if you don't get a move in the RSI above 75, you generally don't see much of a pullback. You mostly see a little bit of a sideways consolidation, which is a lot like what we saw when we got into April and May of 2023. And I've done some back testing again as part of my processes, and my back tests have shown that that shorting at RSI 70 is not a super profitable endeavor. The median change after 1 week is barely minus 1%. After 2 weeks, it's barely minus 0.5%, and then once you go beyond 2 weeks, it's basically not profitable when you short at 70. So obviously, I'm not saying that we're going to sell off here, but what I'm looking at is maybe something similar to early April of last year, where we had a pretty swift run up and then kind of moved sideways as the markets waited for further data, further earnings releases, and things like that. That's kind of what I see over the near term, the very near term, like the next few days into next week. Obviously, it's a short week, low liquidity, so I could be totally wrong. This could move wildly one direction or another, but that's kind of what I see in the week ahead. And then as far as into the medium term, something I wanted to talk about a little bit was some updated data that we got. Obviously, the NBER, the 6 NBER indicators where they decide when a recession has happened. Obviously, only a couple of these update every so often. So usually we have a week where payrolls gets updated. That's on the left pane, the two sets of bars on the left. We just got this week an update to industrial production. That's this first set of bars in the second pane. Usually during the week of CPI, we can get usually the week before CPI, we get the retail sales numbers, usually in the first or second week of the year, depending on where the dates fall. And then, of course, at the end of the month, we get the PCE reports on real PCE and real personal income ex transfer payments. So almost on a weekly basis, we get an update of sorts to these indicators. And one of the things that I think is interesting about the last couple of data releases, starting basically with the payrolls report, is the declines, which are now below trend, or which have gotten below trend, at least in payrolls. So we got a below trend and below expectation establishment print. The employed numbers on the household survey were down in the negative significantly. Last week when we had the retail sales report, the year-over-year number came down below the pre-COVID trend, and the rate of change on the 3-month annualized rate of change also decelerated from the level that it had been at. So it's still increasing, but at a lower rate than before. That was a big change. And then this week, when we got the industrial production numbers, industrial production had been rebounding the last couple of years, as you can see from the yellow bar. But this month's set of data was a big miss to the downside, and that brought the rate of change back to pretty significant negative territory. And the year over year is not only below trend but negative. And to me, this is indicative of right at the time where the data is actually really starting to show slowdown in the economy, but then a lot of people are cheering soft data because they're thinking, Fed's going to pivot. Well, what I point back to is the Fed pivoting usually is a sign of bad things taking place, but a lot of people are looking at the softening data as, soft landing is going to come. I'm not so sure about that. I only think that we're just now seeing the effects of the rate hiking cycle. And then the other data I wanted to look at is the jobless claims, and what has been happening is the continuing claims, which is the bottom frame, has been increasing for, I want to say, about 7 weeks in a row, and has continued to be higher week by week. And the initial claims are starting to come up a little too. And my question is, are we about to see the breakout in jobless claims coming soon? Because typically the equity markets peak within a month of the breakout of jobless claims. So and then of course the weekly continuing claims is going to be a good indicator of whether or not we're going to see an increase in the unemployment rate, which already came up again last month. If I recall, I think it's 3.9. So if the continuing claims continue to be up, then it could be that we see an unemployment rate with a 4 in front of it. And I wonder if that will be the point where the markets are going to start getting spooked. Point being that a lot of the data is, if you think about the story of 2023, people got short thinking we were going to be in recession first half and then up second half, so they thought we were going to come down and then up. But the economy remained resilient despite bank failures and otherwise. And then, of course, we had the AI narrative, and markets, just careened to the upside. And then we got a pullback finally, and then people are starting to talk about seasonality into year end, and we might get the Santa Claus rally. I'm not really sure. When I went back and I looked at my old newsletters from the summertime, when I used to write about longer term outlook, I wrote that. I thought the time frame was going to be quicker. I thought we were going to see a pullback sooner than it actually came. But I had been talking about getting a summer pullback that would trick bears into thinking that that was going to be like the doomsday, like now the markets are going to crash and we're going to go into recession kind of a thing, just in time for it to turn back around. And that kind of did happen. Like down here we had people talking about circuit breakers, and all these different kinds of things, doom and gloom, after this pullback. And markets are closer to their highs for the year than they are to those lows that we had just a few weeks ago, which is wild. So point being that it's one of the things I commented on back then was that people are going to get people are going to get over bearish. They're going to try to sell this down. The markets are going to come right back up, and then everyone is going to think that we're all clear right at the time when the data starts softening and we have to actually start thinking about recession. So one of the things that I would point to is the price action in gold, which today was really interesting because we were up pretty strongly on the day and ended up closing negative. So that's something I need to go look at positioning data for. But I've been saying for some time that there hasn't really been a fundamental reason to buy gold. And of course, this move was largely over bearish positioning plus war in the Middle East that kicked this thing up. Very similar to the move that we got back in 2022 when Russia-Ukraine started. So that'll be interesting to look at. I still think that gold's the best performance will happen after we get kind of like that credit cycle downturn sell-off that often happens preceding recessions, and then gold is going to go up. And here we are on November 17th. I'm not sure how many trading days are left this year, but it's fewer than 30 trading days that are left for my prediction of no new all-time highs in gold in 2023 to come to fruition. So kind of hanging by a thread on that one, but I stand by that to this day. But my point is that it's something that I'm watching because I'm wondering if people are starting to pre-position in gold anticipating the recession. And that would tell the same story that crude oil has been telling for some time, except that today we had a pretty strong up move, where I kind of see this up move as a kind of a bounce back, little relief rally after the heavy selling that's been taking place the last couple of weeks. So the question is are commodities like gold, which is the growth scare safe haven, and then crude oil, which is the demand fears mover, are these also signaling that recession is coming? Are the moves in yields that have been coming down indicative that a recession is coming? So there's a lot of things to think about. And while you might say, well, why then, if those things are starting to price in recession, then why are equities coming back up? And really, and there's been some people, Darius Dale, 42 Macro, among others, has done a lot of work on the performance of the stock market ahead of recessions, and it almost always booms, and the biggest part of the boom comes right before the recession, right before the recession actually commences. So those are some things to think about. I guess my word of caution is that in terms of actionable ideas, over the next week, I think largely the movement will probably be sideways, at least for the first couple of days. Maybe we pull down a little bit. At this point, it's hard to bet against the markets moving up. So I'm not going to discount the idea that the markets may continue their upside move. I just think the highest probability at this point, just given where things are currently at, is that the first few days and maybe all next week is more sideways. And then I think the short to mid-term trend will continue to the upside. But I think it'll be interesting to watch some of that data, PCE data at the end of the month, the next payrolls report in January, and then of course CPI in December are going to be some big tellers of the direction of the economy. So again, you got to keep things systematic, and you got to back test, and you got to And at the end of the day, whatever your systems are, whatever your research is, you got to make sure you put the trade on, whatever the trade is, and follow your rules for getting in and getting out. And I can't do much more than that. It's about risk management. So the risk here is that maybe the economy is slipping into recession a little bit faster than a lot of people think. On the bullish side, there are a lot of people who are getting back into the recession is coming in the near term camp, and that could just be fuel for more upside. So if you can hear it in my voice, while I think that the probabilities are more to the upside in the short to medium term, there is uncertainty, and in the face of uncertainty, you have to be a really strong risk manager. So if nothing else from this video, that's what I hope that you get from it. So I'll leave you with that. Next week we will not have a video, so I will be catching up with you guys 2 weeks from now. So thanks for tuning in. I hope you guys have a great week and a happy Thanksgiving. I'll see you guys next time.